Yo, what's up, everybody? Friday. Check it out. Every day going boxing. I'm 67 years old and I spar every day. There's a kid in the gym. He's 17 years old. He's really good, man. And I was sparring with him today. He's very quick. I got the reach. Man, I got a really long reach, so I try to use my range. But I'm a novice at this game, but I love it. If you, I don't know if you guys, hopefully you do some kind of exercise, you have some routine to stay in shape. It's very important as you get older, but I find that boxing is just an amazing conditioning. It's a great skill to have, and the atmosphere in a boxing gym is like none other. Like, I've been working out in gyms my whole life, weightlifting gyms, and I did some Brazilian jiu-jitsu, but it's just something about a boxing gym, the atmosphere, the camaraderie. It's really, really great. So if you have one in your neighborhood, if you haven't done it, check it out. If you do boxing, leave me some comments. I want to hear about it, and it's a lot of fun. And so anyway, it's Friday, folks, and we had a crazy week. We had a crazy 2 week. This was the biggest or the best week of the entire year so far. That's what they're saying. That's what it was, actually, the rebound. I am still of the belief, and I truly think that this was a conditioned response, this buy the dip. It took a long time for this to become ingrained. Like, if you go back to last year or late 2022, you had the same exact behavior on the downside, that every rally was sold until it became, well, not even until it became obvious that conditions were changing, but until the market, started to move higher. And then we went through a long period, most of 2023, where there was such a high degree of skepticism. And that's the kind of environment that I really love. I think right now what you're seeing is what I just said, a conditioned response off of that big sell day we had on August 6th, when the market was down like 1,000 points on one data release, which actually came the prior Thursday. That was the weekly unemployment claims, which was higher than what they thought. And they went crazy and sold the market down on that following Tuesday. And then the conditioned response came in. Folks, I'm going to repeat that the stocks follow the economy. It may not be obvious on an instant, but it evolves over time. I looked today at the Atlanta Fed's GDP Now forecast for the third quarter. They revised it down again. It is now 1.99%. Remember, we had a 2.8% print for the second quarter. That was above my estimate, well above my estimate. And I admitted that, and I said that because I said we shouldn't have anything higher than a 1.6%. Most of that gain in the second quarter came from inventory accumulation, which is great because that should keep prices, a lid on prices. Hopefully it'll bring prices down, so that helps with the whole inflation outlook. But I also said, as firms boost inventories, that's an investment that they have to recover, and they recover that through sales. Now, we had a strong retail sales number on, I think it was on Monday, and that's what triggered this whole entire rally. Yesterday, I talked about this volatility, this kind of manic behavior, okay, which has become very pronounced. You get a lot of this anyway in the stock market because you're dealing with human emotion. But when you start to see this volatility bouncing around up, down, up, down, up, down in big swings, okay, that's usually indicative of something internally that's changing. You got distribution going on. Distribution meaning that, you have a lot of people right now for the first time jumping into the market. And then you have insiders, people who have been in this for a long time, on the buy side, on the long side, and they're slowly distributing their stock out. And this is what creates the turning point. A 1.9 or 1.99% GDP growth rate. You know, we had 3.2% in the fourth quarter of 2023. Then we had a 1.6% in the first quarter of this year, 24. Then it popped up on that inventory build, and now they're looking again at a sub 2%, GDP growth rate. So, you know, take that for what it is. I mean, I look at that, and that's not a trend that says to me you have steady or expanding economic growth. That's a trend that says to me that that's slow growth, okay? Anything under 2% or even in the 2.5% growth range, if you look at historically what the U.S. economy has done, I would say it's more like around a 3.5%. I mean, we're below average. We're sinking again in the third quarter. You got investors now coming into stocks for the very first time on the basis of this interest rate cut, which is going to happen on September 18th. By the way, that's now a 25 basis point cut. You know, I talked about this, I think, in a video yesterday where I said on August 6th, when we had that big decline, there was panic everywhere. And they were saying, the Fed needs to do an emergency cut right now, an emergency cut. And then it went to 50 basis. Then it's like, okay, we don't need an emergency cut anymore. We need a 50 basis point cut. And then it's like, well, we don't need a 50 basis point cut. We need a 25 basis point cut. Next week, they're holding this symposium in Jackson Hole. Beautiful spot, folks. I don't know if you've ever been there. If you haven't been there, you should try to go. I've been there several times. Went skiing there in the summer. Wyoming is absolutely gorgeous. It's absolutely gorgeous all year long. But I mean, the summer is really, really beautiful. So all these central bankers convene in this beautiful Jackson Hole and they talk for a week. And I think Powell's going to be talking on Friday. And, you know, everybody's going to be parsing every word. And even before Powell, you know, they'll be listening to the other central bankers and what they have to say. And in general, with the exception of the Bank of Japan, which for a reason I don't understand, is now raising interest rates when every other central bank is starting to cut interest rates. So just expect a lot of volatility next week with this Jackson Hole thing. I wish I was out there, but actually it's pretty nice down here, so I don't mind at all. Yeah, I mean, other than that, I said yesterday I think the rally is fake. This rally off of the sell-off that we had on August 6th. I look at the economic outlook. I don't look at, you know, past economic data. I try to forecast ahead, forward. And I've been pointing out the drop in year-over-year net government transfers, number one. I've been talking about, and I've been saying, we're going to come into a very interesting time, and it's going to fool a lot of people. I know many of you, maybe some, maybe many of you, you don't think what I'm saying is correct. You don't think what I'm saying is going to happen. You think it's the exact opposite. But I'm telling you, just get ready. And remember that I said it, and even if you don't remember that I said it, we're going to come back and revisit it, that these interest rate cuts, you know, now we have like a $250 billion drop in year-over-year net government transfers. Once the Fed starts cutting interest rates, you know, it'll happen slowly at first. It'll be evident almost right away in the discount on Treasury bills. But then as they start to cut, we're going to see those net government transfers go down, all right? And that is the first derivative. I always say this, that is the first derivative of economic growth. It's even the first derivative of credit to a degree, because all credit is based on the ability to repay that loan. I mean, if you go into a bank, the only thing the bank looks at is your credit worthiness, is your ability to repay the loan. That's the only thing standing in between the bank lending you money or not. if you are credit worthy, if you can prove the ability or show the ability to repay, you're going to get a loan. Banks want to make loans. That is a big part of their income. All right. So when these interest income transfers go down, it reduces or it slows the growth in national income, in personal income. All right. And that's a factor. That's a macro factor in everything. So just keep that in mind. We're going to come back. We're going to talk about this in I don't know, 6 months or a year. And you're going to see, just like what I told you guys when they started to raise interest rates, I said the market's going to take off. We're going to make new highs like nobody could ever believe. And that's exactly what happened. Okay. And I'm saying it's not going to work out with these rate cuts like they think it's going to work out. Oh yeah, I forgot to say, please like and subscribe. You guys, I got to hand it to you. You've been great. You've been fantastic. I see the number of subscribes going up. I'm really appreciative of that. Thank you very much. Please like, and don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. By the way, the report, last week's report, I put in there, you got to buy gold, you got to buy silver. Those prices were way down. I pointed out that gold open interest in the futures market had dropped to a very low level, and that is usually consistent with a buying opportunity. And what happened this week? Gold hit a new all-time record high. Silver bounced up too. There's new information now based on the CFTC report that just came out a little while ago. I'm going to have that in my report. So don't forget to sign up, because I'm going to tell you like where it's going next. If you like trading gold, if you like trading oil, all right, I put all that stuff into the report. Oil, by the way, had a good week. Some new developments in there as well, which you need to be apprised of. And so yeah, it's all going to be in the report. Sign up at pitbulleconomics.com, and please like and subscribe if you've already done that. Thank you very much. I appreciate it. Have a great weekend, guys, and I'll see you on Monday. Bye.